Welcome to TSIB Talks, where we share information on construction insurance and its possible effect on your business. Enjoy our latest episode.
So before we get started, would the both of you like to introduce yourselves real quick?
I'm John Surano. I'm a Surety analyst at TSIB.
And I'm Jim Baldassare. I'm the director of Surety.
Well, welcome guys. We're excited to have both of you on today. To kick things off, let's start with a few basic questions for those who don't know. So what is a surety bond?
A surety bond is a three-party written agreement between the principal, surety, and obligee to guarantee compliance, performance, and payment of an obligation.
And what exactly is a surety and what is an obligee?
The surety is the party that guarantees the performance of another for the benefit of the obligee or the owner of a project.
And an obligee is a person or entity to whom an obligation is owed.
All right, well, thank you for that clarification. And let's dive in a little deeper here and start off with, how do you obtain a surety bond?
Well, surety bonds it's actually a pre-qualification process. It's unlike insurance, you have to qualify for a surety bond. So there is a set criteria that an applicant has to go through in order to meet the requirements to qualify and obtain a surety bond. So unlike insurance, which is already looking at you're a lot where a loss is expected and you're pooling risks, surety bonds are used as a risk mitigating factor to mitigate loss so that loss doesn't occur. That's why it's a pre-qualification process. So anybody that's obtaining surety bonds, performance and payment bonds, in this case, construction contractors, they have to provide detailed historical financial information, usually the last 3 fiscal years worth of CPA prepared financial information, along with supporting job schedules, both work in progress and completed job schedules that tie into each other so that the bonding company can effectively underwrite those financials, confirm profitability, and determine whether or not a construction contractor has the wherewithal and the capacity to complete those jobs and make sure that the bond fulfills its obligation.
For example, why does my credit history matter when obtaining a bond then?
Well, credit history is just one of many factors in there. And specifically, it gives a historical perspective of your ability to pay your bills. And whether you pay your bills, whether you don't pay them, whether you pay them on time, or whether you're late paying them. So credit history is a big factor when determining whether or not a contractor can qualify for bonding. Because if you're going to pay your bill, if you're not going to pay your bills, or you're going to pay your bills late, there's not going to be too many lenders that are going to want to lend you money.
And Jim, just like on a personal note, if you were to apply for a mortgage, you'd have to pre-qualify with a bank based upon your financial capacity. In the surety world, business has to qualify based on their credit worthiness as well.
Absolutely.
So stemming off of that, why would I be required to purchase a surety bond?
Well, surety bonds are mandated by law. All right, it started way back in 1894 with the Hurd Act, which required contractors on public works jobs to provide financial wherewithal that in case they went bankrupt on a federal job, that there would be a bonding company that could step in and financially fulfill that obligation and make sure that job got completed and the taxpayer money did not go to waste. That was later supplanted by the Miller Act of 1935, which required a performance bond and a payment bond. The performance bond guaranteeing the performance of a construction contract, a specific construction contract, and a payment bond, they go one and the same, that is there to make sure that everybody on that job, whether it's laborers, subcontractors, suppliers, to make sure that they get paid. And again, the ultimate job of a performance and payment bond on a public works job is to make sure that taxpayer money that's earmarked for that project is not wasted and that project gets completed.
And then the states followed suit with their own little Miller Acts to make sure that state taxpayer dollars were protected in the same way.
Absolutely. And I believe the threshold for federal jobs is $150,000. Any federal job that's over $150,000 is required by law to provide a performance and payment bond to make sure that that work is completed. And then the Little Miller Acts on a state and local basis, those are determined, by each state on what threshold that they want to, decide a bond is needed.
So dealing with these projects and the bonds that are going to be coming with these projects, I believe the two most common types of bonds are contract and commercial. Can you guys just kind of walk us through the difference between them?
Sure. Contract bonds, which are probably the most common to the public, that's a contractual agreement between the three parties: the project owner, the contractor, and the surety company. And what happens is the surety guarantees that the contractor will complete the project as stipulated in the contract. And there's different types of contract bonds. There's a bid bond, there's a performance and payment bond, and then there's some additional bonds like a warranty bond or retention bond.
Yeah, and commercial bonds, they're just financial guarantees for performance obligations. They're required by public authorities to protect the general public against loss and the event of whether they violate some regulations that are on the books. And, different commercial bonds include license and permit type obligations, court, judicial bonds, union bonds, right of way, subdivision bonds, etc.
So hopefully that helps clear up any kind of confusion that might be for our viewers. Now to kind of shift gears a little bit to the cost side of things, do surety bonds costs vary per state?
Well, each surety company is required to file rates with each state's insurance department.
Surety companies are the same as the insurance companies, and it's a regulated industry. Rates are filed in each individual state so that the contractors and consumers know exactly what rates exist, and the rates are predetermined by the surety companies in the state that they're filed. So the rates aren't arbitrary. They've already been filed and approved by every state's Department of Insurance. Surety bond costs will vary from applicant to applicant. Just as we spoke about an individual applying for a mortgage, not everyone's mortgage rate is the same because the company issuing it will look at the applicant's credit worthiness. In a similar fashion, when it comes to surety bonds, the surety companies are going to look at the credit worthiness and capacity of the person and or entity applying for it. So their rates are going to vary on the level that the surety company views the exposure to be.
Correct. And these rates there's not wild swings in the rating structure. There's a certain set amounts in terms of rating structures where you would qualify. And I think the vast majority of the smaller mom and pop shops that operate, they'll qualify for a rate. But one of the big jumbo accounts that has a lot of capacity, a lot of financial wherewithal, they're going to qualify for a little bit, lower of a rate, but, they're just going to make up with the capacity that they qualify for.
So then from a TSIB perspective, what would you say are some of the surety services that TSIB can offer out there?
TSIB is a full service brokerage, and we can handle small, medium, large, jumbo size accounts, which include both commercial and contract surety bonds. And we have the ability to effectively help and manage small contractors with a total surety program of $5 million or less, or we can rate a jumbo size individual account that has bonds in excess of $1 billion. We deal with all A-rated or better AM Best surety companies who have both ample capacity and competitive rate structures for all companies across the board.
The TSIB analyst team also can review contracts and help our clients try to mitigate onerous contract terms and negotiate out of bad contract terms as well. So our team looks to dive deep and provide the best service available to our clients.
So, what happens when there is a loss?
When there is loss, and we're going to provide that to the loss, and we're going to make that loss whole. Bonding is the complete opposite way. Bonding is going in with the thought that there isn't going to be a loss. You are pre-qualifying, you're prejudging, qualifying this contractor to make sure that there is no loss on the job. So that's how they qualify for a bond. That's why you look at all the historical financial information. You look at historical jobs that they've completed. You perform reference checks, bank checks. Do they have a line of credit with the bank? How's their payment history with Dun & Bradstreet? Do they have any UCC filings that, again, have they defaulted previously on jobs? Do they have an existing bonding relationship? Has the bonding company ever had to step in and complete one of their jobs that's been bonded? All of these are questions that you need to ask when you're underwriting an account. And, we can do that. Take the underwriting process from, the beginning to the end. And we can set them up with a bonding company that is the right fit for them. And Yeah, that's what we do.
So what would happen if they have defaulted or if they haven't performed?
I mean, it's not impossible, but that's why you have different markets. There are different markets out there because the bonding company, let's say you have defaulted and the bonding company has to step in, but but you continue to do public works jobs where bonds are mandated. There are surety companies out there that will write your bond, but they're going to require you to post collateral with them, and whether that be in the form of a revocable letter of credit, cash. Some of them take real estate, property, things of that nature in order to secure a bond line, but you're also going to be paying a higher rate because it takes you more to qualify for a bond with the a requirement that you utilize funds control on a job where you have an outside third party company that administers all the money, all the funds. They get the checks from the owners. They have your payroll. They make sure they cut your payroll. They make sure all your sub suppliers, everybody gets paid, and they take a cut out of that to make sure that everything gets done. But that's a third party a contractor that takes care of that portion of the work that for the surety company. So the surety company has peace of mind because there's a lot of mom and pop shops out there that have been around for God knows how long, and a lot of these the older guys and the older gals that have been doing this, they know how to build houses, they know how to build buildings, roads, pools, whatever structures. What they're not good at is the back end office stuff. They're not good at the paperwork. They're not good at the accounting and the invoicing and stuff like that. So when you can help them, when you can help out a company like that, and you can give them some of the back office then work, that will allow you to be able to bond them or find a market that will bond them, with the understanding that certain things are taken care of.
Now, what if they're a newer mom and pop shop and they're looking to start work on a bigger project? Where do they start?
Well, you always start small. You got to walk before you can run. You have to crawl before you can walk. So, I mean, like if you're a new upstart out of the gate company that wants to do, work, first of all, the first thing you're going to have is a solid capital structure under your company. And then because, when surety companies look at a company, a contractor to bond, I think about 70% of what they're looking at rests on the financial position of the contractor. And the other, 30 is split up between historical job experience, job size. Do you have effective tools at your disposal just in case? A bank line of credit. How long have you been with the bank? How much is the line of credit at the bank? What would you do in terms of if there was a shortfall in cash? How's your cash flow? So they want to make sure like a lot of things that are there. But if you've been working for a contractor for the last 20-25 years and you decide, hey, I'm going to go out on my own. I've done projects that are $50 million. I can do these. I manage these projects, and I can go out and do this on my own. It's going to be very difficult for you to go out and immediately get a $50 million project, with your new company, given the fact that, you may have worked on it, you may have managed it, but your company's new and your company needs the track record, and you need to have that profitable track record with your company. And what bonding companies want to see is they want to see a profitable company that grows every year. And you want to start small and you want to continue to build, and you want to build your equity and your working capital, your net worth of your construction company. The more that you do that, if you show the bonding company that you can successfully acquire projects, do the projects, make money on those projects, be profitable, and then at the end of the year, retain some of that profit that you've made and keep it in the company, building the net worth of the company, building the equity of the company. That will allow you to grow your company with the bonding company. So let's say the bonding company starts you at $1 million job. You do $1 million job. Next year, you want to do $2 million job. Well, you do $1 million job, and let's say you put, I don't know, $100,000 into your company at year end. Right? So your company is now worth $100,000. Well, next year you're gonna, you'll do another $1 million, and you put another 100,000. Now your company's worth $200,000 at the end of 2 years, and you're comfortable with that job that you've done, and you think you can do a little bit more. So you say, instead of $1 million job, I want to do a $2 million job. Well, your balance sheet, the equity of your company, and now $200,000. That's given the bonding company a pretty good idea that, okay, yeah, you're growing, you've been profitable. It seems like the next logical step for you. So we'll do that. We'll go ahead and we'll support you on that. But it's based off of what your company is worth, what you have in terms of equity and whether you're profitable or not and how you manage that profitability.
So now with all of this information that we just learned, why should someone choose TSIB for their surety needs?
The surety team at TSIB has the ability to handle the largest jumbo accounts with billion-dollar capacities and contracts. We have the expertise to provide solutions and provide complex bonding solutions with complex projects. We can also service a small contractor who's just starting off in the market too. So we can be a one-stop shop for everybody, whether you're the largest of contractors or a small mom and pop just looking to start their surety program from anew.
Well, I think that is the perfect note to end on. So, with that being said, I would like to thank both of you for coming out today. I definitely learned a lot, and I think our listeners will also learn a lot. So, I really appreciate it. Thanks, guys.
Appreciate your time, Dom. And of course, if anybody has any needs, they can find us on our webpage and contact us directly.
Thanks for listening to this episode of TSIB Talks. If you like this content, be sure to follow for new episodes. Until next time.